Hey, what's going on, folks? In this video, I'd like to hopefully explain simply what a call option contract is. This is for people who are interested in learning about derivatives trading, specifically as it applies to options. Options contracts are a type of derivative you can trade in the stock market. A lot of people have heard about them. They see that there are some special benefits. There are also some special risks to trading these. I just want to simply explain them so you can decide if they're for you and if you want to learn how to start trading options. This lecture is about call options. All right, so let's get to it. So what is a call option? A lot of people think that options contracts are like bets. I like to consider them like agreements because options are based on contracts and contracts are agreements. So there's a buyer of the option contract and a seller of the option contract. What the buyer and the seller agree on are three main things. There's going to be a strike price. That's the price that you'll buy these 100 shares. There's going to be an expiration date, and then there's going to be a price or a premium of the buyer of the contract that they accept to initiate the trade. In American options, you are not obligated to exercise this contract at the expiration date. You can sell off your contract before it expires. Okay. In European options, you're kind of held to that contract until it expires at the expiration date. Okay. So why would I want to buy 100 shares at a particular price? You've got to look at the motive. Some people do that because they think that this price will go up, and so they'll buy what's called a lot of people will buy call options because they think a stock price will increase in the future and they want to lock in a low price. Some people use options to hedge, like if they think the market is going down but there's a chance it can go up, they may buy call options to protect their down directional trades. Okay, so let's look at an example. Let's say I want to buy a call options contract for Plug Power. That's a stock with a ticker PLUG. Plug is trading at $15.89 per share. Let's say, so I've got to consider my strike price, my expiration, and my premium in this call option I'd like to buy. So let's say I pick this $16 strike price. So I want to buy 100 shares of Plug Power at $16. It's a little bit more than what it's worth now, but it expires February 3rd. So let's say I think Plug Power may go to $20. I can lock in a price of $16 a share. And at February 3rd, if the price is above $16, I will be able to exercise that contract. If I have $1,600, I can buy 100 shares of Plug Power at $16 a share. So you keep cash along if you're buying calls as collateral for the agreement, as what you're holding aside. So because you're going to either exercise this or you're not. You're going to sell. You can sell the contract before it expires. So why would people do that? Maybe the contract itself gets more expensive. We'll talk more about that later. So I've agreed. And so here's our expiration date. This menu is called, kind of like an options list or schedule. It's basically a menu that tells us what contracts are available and, what expiration dates and whether I'm buying or selling a contract and whether it's a call contract or a put contract. We'll talk about puts in a different video. But you'll find that the more popular stocks and the ones that are traded in higher volume or that are more volatile, they'll have a lot more expiration dates. Here I've chosen one that's about a week away for $16 a share, and I'm going to pay 59 cents per share of premium times 100 shares because the contract is agreeing to buy 100 shares. So this will cost me $59 in premium money just to make this agreement, this conditional agreement, if I decide to exercise or not. Now, if the price is lower than the $16, I can still exercise the contract, but it wouldn't make a lot of sense because I'm agreeing to pay more for those shares and I'm paying a $59 premium. So if I buy the shares, 100 shares at $16 on February 3rd, when this expires, we're still in January, and Plug Power goes down to $15. If I want to sell those shares, I've lost $100 because I paid more than I'd be able to sell them for. So really, you want to buy calls if you're expecting the price to go up. So if I'm a buyer of the option, I want to be right because I'm paying to be right. I also don't want to overpay for my premium, and I want to get out of the trade quickly if it doesn't go my way. So I have to decide if I want to be in this trade long-term or short-term, and I have to decide what amount of risk I'm willing to take on. Some people will buy options because they expect the price to go up, but they want to sell before February. Let's say tomorrow the price goes to $20. The actual contract gets more valuable because more people will want to buy shares at the $16 if it's at 20, and you want to lock it in. Sometimes it's smart to buy a lower strike price. On the other hand, you pay the better the conditions of the contract, the more premium you pay, right? So there are some caveats. So a common thing that people do if they don't have a ton of money is they will buy the options contract, and as it becomes more valuable, if it's $59 of premium now to accept this agreement, but the price shoots up to $20 later in the day or tomorrow, this contract may be worth $200, in which case, or I could sell this contract at $200. I've paid $59, and so I make a profit of $141 just because I held on to this contract. So you can trade options contracts like shares. You can buy them and sell them before the expiration date, or you can just lock in the price and wait till the expiration date. But if it expires at expiration, you're going to be expected by the broker to pay for 100 shares at $16. Now, if the price never hits $16, or if it stays underneath $16, you can also let the contract expire worthless and you just lose $59. That's where people think that options contracts are like betting. So it's basically saying, okay, I'm betting that you can play it for what's called extrinsic value, and we'll talk about that. But you can play it for the actual contract to get more valuable. So if the price shoots up really quickly, you can just buy the contract low and sell it high to somebody else and get out of the trade. Or I could just, for $59, lock in a $16 price, and I can hold on to those 100 shares after February 3rd, as long as I'm able to pay the $1,600. See, if I accepted a $17 strike price, I'd have to pay $1,700. I'd agree to that. So there's different ways to play options. A lot of people with smaller money like to just trade the contracts because they change price based on the direction of price movement. Now, if the price moves against me and it moves downward, this contract where it's $59 right now, it might only be worth $40. So if I decide to sell it, I'd be selling the contract at a loss. So what influences the price or the premium of that contract? Okay. So how is premium calculated? Well, these options councils that make these price menus, they calculate premium based on what's called the Black-Scholes model. And I've shown it here. It involves some pretty freaky, geeky mathematics. But the main things that these variables consider in the price of an option premium are the strike price of an option, the current stock price, the time to expiration, the current interest rate or federal funds rate, and the volatility of the market. Okay, these are all kind of in this cocktail that spits out a premium. The big things we pay attention to in our trading group are the strike price, because we can choose what price we want to buy that contract. The stock price, right? Because whether it's close to the strike price or not. We want to know how much time we have to make this agreement, and we want to know what's the volatility of the market, because the more volatile a market, the higher the premiums cost. So maybe it's not the best time to buy options contract. So people talk about at the money, in the money, and out of the money options contracts. At the money means the closest strike price available for sale from the current market price. So we're talking about at the money. If the price is at $15.89, our at the money is $16 or $15.50. These are in increments of 50 cents based on how much this stock tends to move. Bigger stocks have bigger gaps between the strike prices. At the money are the closest ones to the actual price of the stock. In the money is a strike price on the other side of your trade. So if you're bullish and expecting the price to go up, the strike price of an in the money options contract call option would be below the current price. And if you're bearish, the strike price is above the current price. So this is the opposite for put contracts. Out of the money, a strike price is far from the current price, but in the same direction of the trade. So if you're bullish, the strike price is above the current price. If you're bearish, the strike price is below the current price. And that's the opposite way for put contracts. So our out of the money, if we're at $15.89 here, if we're saying we're buying an out of the money contract, it's above $16. And we're further out of the money, $16.50, $17, $18, $19, $20, and on and on and on. The options calendar will go all the way up to $25, $30 maybe, right? And then in the money means if we're at $15.89, anything below that, so $15.50, $15, $14, $13, $12, $11, $10, etc. for call contracts. Now, which do I buy? Okay, so it depends on what you're trying to do. Are you short term or long term? Are you playing it risky or not risky? Don't feel pressure to pick a strike price or an expiration based on your income. This is a common beginner mistake. A lot of contracts that have a lot of risk or are less likely to happen, they have cheap premiums because they're less likely to happen. Somebody's trying to just sell you that contract, but it's not likely to work in your favor and you lose money, right? It's harder for those to want to, it's not fun to keep those contracts. So they're cheap, but they're pretty reliable way to lose money if they're very, very cheap options. Unless something out of the ordinary happens and that, the price moves in your favor to make that contract more valuable to you. You want to pick a contract based on your trading plan. Okay. What do I recommend? I buy a lot of contracts close to the money. So in the money or at the money or slightly out of the money. I want strike prices. If it's $15.89, I want something around $16, $16.50, $15.50, or $15. And the reason is because considering these factors, you kind of have to study options and how the price of the premium changes. But what happens is if price moves against you and you have a short window of time, the value of the contract loses. It loses a lot. The value of the contract becomes less. And if the contract moves really well in your favor, the contract holds on to a lot of its value. That's what we call the difference between intrinsic and extrinsic value. And a good way to look at that is if you think about, there are two players in basketball, okay? LeBron James and Steph Curry. You might not be a basketball fan, but follow me here. Okay. By high school, most basketball fans knew that LeBron James, when he was in high school, would be an excellent player and will probably go to the NBA and, dominate, be an excellent player, score great consistent points, averages, collect a lot of rebounds, etc. So he had a lot of what's called intrinsic value. The value was already kind of baked into who he was and what he had already done in his young basketball career. So when he was drafted, they gave him a lot of contract offers and a lot of money because there was a lot of what's called intrinsic value. Any more value than he provided, if he was averaging, say, 20 points a game and they drafted him to the NBA and he started scoring 40 points a game, he would be gaining what's called extrinsic value. And that's based on potential value in some future time, okay? Steph Curry, when he came out of college, they knew he was good, but they didn't know how good he would be. He might be a slightly above average player, or he might be a superstar, or anywhere in between. So there was some intrinsic value, but not as much as LeBron James. They knew he was good, but they didn't really see, like, best player in the world performances from him. One, because he was playing at a lesser known school with different levels of competition, but they didn't know what his full value could be. They saw sparks of greatness. Now, he turned out to become great, but when he was drafted in the NBA, they didn't offer him nearly as much money as LeBron James because they didn't know what he could be capable of fully. When he performed in the NBA, his extrinsic value went up. He was deemed to be more valuable with time. Okay. Options contracts work the same way. So this contract for $59 at $16 may be worth $400 if Plug Power is moving up $4, $5, $6, $7 a day, because now you can lock in a price at some future date at $16. But Plug Power is going up and up and up and up. So if Plug Power goes to $25 and you bought at $16, you can sell at $25 and collect $900 of profit. So therefore, the the price you would pay for that agreement would be a lot more, because Plug Power is expected to be great, right? It's going to gain a lot of extrinsic value. And so the Black-Scholes model tries to gauge how much intrinsic and extrinsic value stocks have based on their previous price history and movements, based on their previous volatility, based on a number of factors, average true range, how much the stock tends to move in given set points of time. So I pick at the money because it's kind of a nice balance between intrinsic and extrinsic value. If I'm not entirely sure where the trade will go, I won't lose a lot of money. The value of the contract won't diminish too much at first. And if it does gain some momentum, I'll make a healthy profit. If I go too far in the money, there's a lot of intrinsic value. So I could buy these stocks a lot cheaper, but the premiums are going to be higher if I buy in the money. On the other hand, if I buy way out of the money, if I agree to buy Plug Power at $20 and I'm not guaranteed for it to hit $20, I'm paying a premium for that. So way out of the money contracts tend to be a little cheaper because they're less likely to happen for calls. And calls is, you're agreeing to buy contracts, so you're expecting the price to go up. So you kind of have to gauge what's the intrinsic and extrinsic value of the stock, and people do stock valuations and options valuations to better understand that. That's a whole nother study. I'm just giving you all the basics. So some people also buy really long-term expiration dates. Those are what's called LEAP contracts, LEAP contracts. There's an acronym. I can't remember the acronym, but basically you pay a hefty premium. It's usually at more than $1,000, sometimes $2,000 and up. It could go all the way up to $10,000, $20,000, depending on the price of the stock. But you get to lock in a price for a long period of time, and that gives that company a long time to grow, right? So picking farther out expiration dates costs more in premium as well. And that's one of our factors if we go back to this slide, the time to expiration. So out of the money contracts tend to be less expensive because they're less likely. In the money contracts tend to be more expensive because they're more safe, more secure. Longer contracts tend to cost more. Shorter contracts tend to cost less. And volatility tends to, that's the other major consideration. The more volatile a stock is, the more the premium tends to cost. And then there's the volatility of that particular stock, and there's the volatility of the market itself. So those can both influence the value of those contracts. So what type of contract should I pick? It depends on what you're trying to do. If you're short term, if you're long term, are you playing it risky or not risky? Don't do beginner mistakes. Don't feel pressured to pick a strike price or an expiration based on your income. That's a common beginner mistake. a lot of people will try to buy options that are way out of the money, but less likely to work in their favor because they have a cheap expiration date and they're just hoping that the stock flies to the roof and they'll buy a cheap call. A lot of people will try to buy shorter term contracts that expire quicker, but that gives you less time. And if the stock doesn't reach your target price, based on the premium you pay, you're just paying a premium. And if the stock doesn't move, you waste your money on premium. So you want it to actually exceed your premium to make it worth your while. The value of an options contract typically goes down with time because now you have less time for the stock price to make its move. If I buy a strike price at say $16 for Plug Power and Plug Power moves to $30, $35, $40, if it moves back to $39 from $40, I'm not going to lose a lot of money on the value of my contract because now it's gained a lot more value. And I bought at such a low strike price, I'm locking in $16 even, and the stock price is way up at $39. So the actual value, the price goes up linear. The value of the contract will move a lot more quickly the deeper you get. And that's because it's less likely that the deeper in the money you get on a call contract, the less risk you've taken on because you bought a cheap contract, and it's going to be very advantageous unless the stock price comes way close back to the strike price that you've chosen. Little changes in the stock price are not going to change the value of holding that low buy price. Okay. So if I bought at $16 and the stock price is way $20, $30, $40 past that, and Plug Power only moves, $1 a day or 50 cents a day, and I only have, a few days to expiration, that contract is still very valuable. But say the stock price moves up to $40 and moves back down to 20 and starts hovering around 17 to 16 right before, and then there's a chance it could slide back under $15, and then I agreed to buy at 16, and now the contract is losing value because it doesn't make sense to buy at $16 if the price is below that. So the value of the contract gets way more valuable when it becomes more advantageous to hold the rights to that contract. Okay. So it's a little tricky, but you'll see it. I recommend buying a cheap call contract and just seeing how the money changes with time. It's not a linear relationship, and the value of the contract is very dependent on where the price of the stock is at expiration, because the terms of the contract, if we go back, are an agreement to buy 100 shares at a very specific price at a particular time for a predetermined premium that you've already paid. Well, if the stock price is way up, then it's good to have a low strike price at expiration. If the strike price is hovering right around there, as soon as the contract dips below your strike price and you're agreeing to buy shares, it's not advantageous, right? And really it's what we call the break even. And the break even says, okay, I've got to cover the $59 that I spent on this contract. So really, I don't want the strike price to go to, I want the stock price to go to $16.59 because I'm paying $1,600 for the shares for 100 shares at $16, but I also paid $59. So I've got to cover that. So I need the stock price to go up another $59 or 59 cents per share times 100 shares for me to get my money back from the premium. So I really want the strike price at the expiration date to be above the strike price plus the premium here in the green. And that is $16.59 at expiration. And that's what they call the break even point. So we want to make sure we're picking a contract based on a trading plan. And you can look at different videos to determine what type of trading plan you'd like to have. But don't pick options contracts based on just cheap contracts necessarily. You want it to fit into a plan so that your trade is more successful and less likely to be a losing trade. Other considerations: how to make a good trading plan. That's a really important part of trading. How to determine the level of risk you're willing to take on. So, picking a good expiration date, because some bigger trading firms, they know that traders with less money pick shorter expiration dates because they're cheaper and they might trade against you. So giving yourself enough time and insurance to know that if the trade goes against you in the short term, you'll have time to recover. So sometimes picking out a farther expiration date is safer, although it costs more money in premium up front. But you can cut out of the trade well before expiration and not lose a lot of money. How to decide whether to trade shares or options? That's based on a trading plan and based upon market conditions and how much hedging you might want to do. You might want to look up how to hedge. And then you want to look at which type of contract you should pick based on the Black-Scholes metrics, which were strike price of an option, current stock price, time to expiration, the interest rate, and volatility. So good luck beginning options trading. My recommendation is to start slowly and start correctly. You can trade options with us. Come follow us. We'll, kind of hold your hand through a few trades. And the more experience you get with these, the more comfortable and the more you'll be able to start using them in your trading strategy. Good luck, folks, and I'll see you in the next videos.